So my name's Sky, and what I'd like to talk to you today about is something that I spend a lot of time thinking about, which I imagine you do too, which is money. And I think about money not so much in what it can buy, but how it can make change. And by change, I don't mean pennies and quarters. I mean innovation. How can capital not just be the source of financing innovation, but how can capital itself innovate? And to give you a little background on myself, I do venture capital, which means I invest in early stage companies that are very innovative, and with that comes a fair amount of risk, and ideally hope with a fair amount of return. The average investment I make, I shoot for usually making about 10 times the capital invested. And when I look for investments, I look for people like Joe. That's his real name. And Joe has a great idea. And he's put together an amazing team. He has a fantastic business plan, but there's one thing he needs, and that's money. Where does he get that money? Well, Joe thinks there's a few places I could get it. Probably the most obvious one that a lot of first-time entrepreneurs think about is that I can go to the local bank. You know, there's one almost in every corner. And if Joe has credit, or if he has assets to lend against, he can borrow from the bank, certainly at an interest rate, which he'll have to pay back over a number of years. But I'd caution a lot of first-time entrepreneurs that if you're about to start a company that has no revenue, it's not good to start your company off in debt, where you have to pay interest payments. So what are the other options that Joe has? Well, he has his friends and family. And if he has friends and family that like him, he can probably get money at some pretty good terms, or almost at no terms. They'll probably be happy if he just pays them back. But you know, Joe is young, he doesn't have friends and family with a lot of money, so what's his next option? He can go for angel capital. If you're not familiar with angel capital, it's typically individuals who have made a fair amount of money on their own from a prior company they started. They usually have a lot of sector expertise, and they look for being a professional investor, investing in early stage companies like Joe. And Joe knows that if he can get capital from angel investors, he can usually raise a few $100,000, maybe up to $1 million. And he knows that the angel investor understands the risks involved in investing in an early stage company. He knows that if the angel investor loses their money, he's not going to cry. Unlike his grandma, who it might be her entire life insurance policy or her retirement, it's better to do it with an angel investor than your family. And lastly, his option is venture capital. If he's looking for above $1 million, oftentimes venture capital is the best choice. But the downside is there are not as many venture capital funds as there are banks. And you're also thinking that you have to have a high growth model that venture capitalists will be interested in. And the real downside is that we only invest in about 1% or less of the companies we look at. So you can think Joe is feeling a little challenged. There's no real great solutions to find the capital he needs to grow his company. And oftentimes, as an entrepreneur, there's a rough size of capital you're looking for. Usually it's 50 to 100,000, up to about a few million. And he is very troubled of where he can actually find that. Now, Joe represents millions of entrepreneurs around the world, and not all countries are in the same circumstances. Let's take Joe and let's put him in Mexico for a second, or any emerging market, where credit is not normal. There are a lot of cash, purely cash economies. So the option of being able to use his credit card is not existent. Or if he wants to be able to get money from a bank, he needs assets to lend against. And the biggest assets that people have in their lifetime tend to be their house and their car. But Joe's young. He doesn't have those assets either, fortunately. But Joe has one thing. He has a paycheck. And he can use that paycheck to build up assets over time. He can save enough, buy a house, buy a car, and eventually use that to lend against and borrow money from a bank. But by the time he is able to do that and have that asset, his great idea might have already been wasted. Who knows, that new competition could come into the space, but he's missed his opportunity if he waits too long to build an asset to lend against. But there's one asset that we may have overlooked that we all have, and that's our brain. Wouldn't it be amazing if we could lend based on our brains alone? Well, there's new research that's been done over the past few years at Harvard's Kennedy School at the Entrepreneurial Finance Lab. And they've come up with a way to come up with people who, if you don't have a credit score, they can give you an entrepreneurial credit score based on taking a psychological analysis over about 45 minutes. And they ask you questions such as, do you like taking things apart and seeing how they work? Or how many numbers can you remember in 10 seconds? But they look at things not just about intelligence, but also ethics and honesty. And right now, this is actually being rolled out in Africa, one of the places where a lot of countries in Africa don't have credit systems, or people have very few assets to lend against, and this is a perfect solution for them. So about 2 years ago, 2010, Standard Bank, the largest bank in Africa, agreed to start doing some test runs, both in South Africa and in Kenya. And so far, the results have been very promising. And if a few years from now, if this is very successful, we could very likely see psychological personality credit scores coming to the US and other places around the world. But let's say Joe, he's not fortunate enough right now to be in South Africa or Kenya to get a psychological credit score. Let's say he's still in the US and he has a bunch of friends that he'd like to pool money from. How can he take his friends and actually make money out of that for his venture? Well, that concept is called crowdsourcing or crowdfunding, and there's really 3 models. The first one is donations. It represents about the majority. It's 71% of all crowdsourcing is that way. It's been largely done by charities who are looking to raise money from their members. And most recently, it's been done by a more innovative way with companies like Kickstarter, which many of you might be familiar with. They've been able to raise about $1 million for companies in a few weeks. But the downside of this model is that investors can't benefit from it. You can't give any of the money back from donations. So what's another form of crowdsourcing? We have lending. Lending represents about 15% of the crowdfunding dollars. And what I find interesting about this is that you see that it's kind of going back to the future on how banks originally were created. In a lot of frontier markets or emerging markets where they don't have a formal banking system, they do a thing called community lending, which is very similar to how we're familiar with banks. They source capital from the community, store it in one place, and then they selectively lend it to people in the community at a higher interest rate than they pay people on their savings or CDs. So this has been pretty effective in a lot of frontier markets and was really the beginnings before we even had what we know as the banking system in the US. And this model can be scaled, but usually only for a few $100,000. It's hard to really get capital much higher than that. So you really have to go for equity. And equity only represents 14% globally of crowdsourcing models. And unfortunately, it's illegal in the US right now to do it. Right now, it's pretty much being done in India and a lot of other emerging markets, but not yet in the US. And why is that? Well, in the US, we have a law that you have to be considered an accredited investor. And the definition of that is that if you want to invest equity, you have to make either $200,000 a year, or as a couple, a married couple, make $300,000 a year, or have $1 million in assets or more, not including your house, to be able to make small business investments in equity. But that's about to change. 10 days ago, President Obama signed the Crowdfund Act into law on April 5th. What this now means is that individuals that make less than $100,000 will be able to invest in small businesses using crowdfunding structures. This is huge. It's opening up to a huge new pool of potential investors. And you think about, this is a great statistic I heard, that if you took 1% of all of the US dollars in long-term investments, it would equal more than 10 times the amount of venture capital invested in 2011. It's huge. But let's look at venture capital for a second and think about the number of fund sizes and the number of investments they could make. Typical venture capital fund you could think is $100 million that invests over 5 years. And they could make either 10 investments or 20 investments in select portfolio companies that they really do a lot of due diligence on. And on average, those investments end up being about $5 to $10 million. Unfortunately, for most entrepreneurs, that's more capital than you need to start when you're really launching. You need more about $1 million to launch your company, $500,000 to $3 million. But that's 100 investments. No venture fund has enough employees to be able to make that number of investments. It's just not manageable. They're not banks. They don't have places, all on every corner. But if we look at a fund 1/4 that size, they can make investments of 10, 20 investments at about $500,000 to about $2.5 million. Now we're talking about the size of capital, which is truly what entrepreneurs need to either start their company or grow it. That's manageable, but you still need a fund that can and bring enough cash flow to operate a team. So let's look at for a second how venture funds keep the lights on. They do it through what's called a management fee, and industry average is about 2% across venture capital and private equity. For a $100 million fund, that means the fund has about $2 million of cash that it can pay salaries, due diligence, overhead, lawyers to operate the fund. But if you have a smaller fund, let's say a $25 million fund that can actually provide the investment capital that real entrepreneurs need to either start or grow, it provides only $500,000 from 2%. And that's just not enough to operate a fund to make the size investments. So you think, what is the solution to creating more funds that could do this? Well, it's a simple equation, you think. It means, how can we increase revenues or decrease expenses to get this fund to work? People's first reaction is, well, just increase the management fee. Let's go from 2% to 4%, and we're done. Well, unfortunately, investors don't want to pay a higher management fee on smaller investments. In fact, they don't want to pay higher management fees at all. So that's not an option. So what else can we do? Well, investment managers that are investing at early stage companies, they need to stop thinking about themselves as just investors. They need to start thinking of themselves as advisors and investment bankers, because they're providing a lot more utility than just the capital they provide. They're helping to find strategic partners, clients, board members, employees. So they should get something of an advisory fee for the portfolio companies they invest in. And in the future, not only the capital that they're putting in, but the future capital to grow these companies, they should also be able to get a capital raising fee on top of that. That would provide enough cash flow on top of the 2% management fee to operate the fund. If you talk about decrease expenses for a second, one of the easiest ways that you can decrease expenses for a fund is what's called shared resources. It's pretty easy. You can figure out, find other companies that you can share rent with. You can share admins, you can share printers and associates. All of these things will make your overhead a lot less expensive. But on the team side, every person, again, needs to be more than just an investor. They need to wear multiple hats. They need to also be the lawyer, or they need to be the accountant to lower costs overall for the fund. So let's look at the capital landscape, both from the number of firms and the size of capital. On the low side, you have microfinance and small loans, usually about $100,000 or less. But on the other side, you have traditional venture capital and private equity, about $3 million and above. And you'll see that in the middle, there's a huge gap in the financing food chain as companies grow from small to large. I call this the missing middle. It represents kind of medium to large loans, crowdfunding, angel capital, and small venture capital. Again, it's between about $100,000 to $3 million is the size of capital that most entrepreneurs truly need to launch and grow. And when you think about this size and what it means of if it was possible to fill this, what would it mean for our economy? Well, about 50% of our GDP is made up from small businesses. And about 65% of new jobs are also created from small businesses, yet only 17% of them receive finance from either a bank, venture capital, or angel capital, crowdsourcing, et cetera. Think about how much more innovation and growth that we would have if we could fill this size of capital. Well, fortunately, a number of years ago, myself and a group of other team members launched what's called the Missing Middle Initiative at the World Economic Forum in Davos. And it was designed to address this exact size of capital. How are current funds able to achieve this, and what are new business models that we can create to allow fund managers to operate funds to invest at this level? If you think about over the past 5 years, there's been a huge revolution in entrepreneurship. We now have entrepreneurial ecosystems popping up not just in Silicon Valley, but also in New York, Boston, here in Connecticut, and around the world. It's amazing what you're seeing. And you're also seeing within the missing middle landscape, there's a huge growth and evolution of capital, where we're no longer looking at capital as being a source of just source of innovation. We're now really seeing that capital is a business itself which needs to innovate to keep up with its demand. And if it does, and it is, the new funds like this are happening all the time. In the past 3 to 5 years, about 70% of all the missing middle funds have been created, which is a huge success. We are seeing a rise of a new asset class, both from debt to equity, and not just return-focused funds, but social funds and impact investing funds. So again, when we look at this and we say, if we could fill the missing middle, if we could provide the capital, the size of capital that entrepreneurs truly need, we could create more innovation in the next 100 years than we have ever seen before. Thank you.